Hello everyone, we are Group A35. This is our video presentation. I'm the reporter of the Case 1. My name is Wang Peijie. I'm studying European languages and cultures. Let's start from the question 1. Compare and contrast the evolution of QE in the USA from QE1 to QE4 with Japan's trajectory from original QE and comprehensive easing to QQE. What were the primary objectives and the specific outcome of each phase in both countries? The United States and Japan both use quantitative easing (QE), but their purpose and evolution were different. In the United States, QE was mainly used as an emergency response to financial crisis. After the collapse of Lehman Brothers in 2008, the Federal Reserve launched QE1 to stabilize financial markets and restore liquidity by purchasing mortgage-backed securities and treasury bonds. QE2 in 2010 aimed to strengthen economic recovery and prevent deflation through further bond purchase. QE3 in 2012 introduced open-ended assets purchase to reduce unemployment and support long-term growth. During the COVID-19 crisis in 2020, QE4 became the largest QE program in U.S. history, helping prevent a collapse of credit market and supporting economic recovery, although it later contributed to inflation pressures. In contrast, Japan used QE mainly to fight long-term deflation and economic stagnation after the exact double burst in 1990s. The Bank of Japan introduced the world's formal QE policy in 2001 to increase liquidity and encourage lending, but economic growth remained weak. In 2010, the Bank of Japan expanded assets purchased under comprehensive easing, including riskier private assets such as ETFs and corporate bonds. Since 2013, Japan adopted QQE, a much more aggressive policy designed to achieve a stable 2% inflation target. Although QQE weakened the yen and temporarily raised inflation, Japan still struggled to maintain stable inflation and strong economic growth. Let's move to question 2. Discuss the fundamental difference between conventional monetary policy and quantitative easing. In your answer, specify the different tools used by central banks to increase the money supply under both frameworks. Conventional monetary policy and QE both aim to increasing the money supply and stimulate the economy, but they use different methods and are applied under different economic conditions. Conventional monetary policy mainly works through short-term interest rates. Central banks use tools such as open market operation, lowering policy interest rates, and reducing reserve requirements by purchasing short-term government securities. The central bank increasing bank reserves, lowering interest rate and encourage borrowings, investment and consumption. QE, however, is an unconventional monetary policy used with interest rates are already near zero and conventional policy becomes ineffective. Instead of focusing on short-term rates, the central bank purchased large amounts of long-term assets such as government bonds, mortgage-backed securities, corporate bonds, and ETFs. QE directly expands the central bank balance sheet and injects liquidity into the financial system. Its purpose is to lower long-term interest rate, raise asset price, encourage lending, and encourage inflation expectation. Therefore, the key difference is that conventional monetary policy targets short-term interest rate in normal conditions, while QE targets long-term rates and financial liquidity during several recession or liquidity traps. Next is question 3. Define the liquidity traps and provide the geographical analysis to illustrate these conditions. Explain why the presence of the liquidity traps necessitates the use of QE rather than conventional monetary policy. A liquidity trap is a situation in which interest rates are extremely low, close to zero, and people prefer holding cash instead of bonds. In this condition, increasing the money supply no longer reduces interest rate or stimulates investment and consumption effectively. Under the liquidity trap, conventional monetary policy becomes ineffective because lowering short-term interest rate further is impossible. Therefore, central bank must use QE instead. So QE, the central bank purchase long-term assets to lower long-term interest rate, increase the liquidity, encourage lending and investment, and rise inflation expectation. Japan's long period of stagnation after the 1990s is a classic example of a liquidity trap. In the money market graph, the money supply is vertical, while the money demand curve becomes nearly horizontal at a very low interest rate. When the central bank increases the money supply from MS1 to MS2, the interest rate does not fall further because it is already near zero. As a result, investment and aggregate demand does not increase significantly. Finally, let's move to question 4. Applying microeconomics theory, analyze the transmission channels through which QE is intended to stimulate US economic growth and achieve Japan's 2% inflation target. Include a geographical analysis using an ADS framework. QE stimulates the economy through several important transmission channels. First, through the interest rate channel. Central bank purchase of bond increase bond price and reduce long-term interest rate. Lower borrowing costs encourage business investment, housing purchase, and consumer spending. Second, through the portfolio rebalance channel, investors save assets to the central bank and move their money into riskier assets such as stock and corporate bonds. This raises stock price and lowers borrowing costs for firms, increasing investment and wealth effects. Third, through the credit channel, banks receive more reserve and liquidity, making it easier for them to provide loans to households and businesses. Finally, through the expectation channel, QE signals that the central bank is committed to keeping interest rates low and supporting economic growth. This encourages confidence and raises inflation expectation, which was especially important in Japan's attempt to achieve the stable 2% inflation rate. In the ADS framework, QE increased aggregate demand by encourage consumption, investment, and sometimes exports through currency dis- depreciation. As a result, the AD curve shifts to the right. In the short run, real GDP and the price level both rise. While unemployment falls in the United States, QE helped economy recover after the financial crisis and the COVID-19 recession. Although it later contributed to inflation pressure in Japan, however, the impact was weaker because households and firms remained cautious, making it difficult to permanent rising inflation to the 2% target.
Next, I am Wang Yuhua from the Department of Southeast Asian Languages. I will be the presenter of Case 2 which will be exploring the AI boom and Taiwan's economic growth. First, at question 1. Based on the background provided in the video presentation questions file, how has the AI boom altered the specific components of Taiwan's GDP? Identify which variables saw the most significant changes and explain the underlying reasons. So, as a result of the AI boom, from GDP formula, I and NX were the most affected components here. Let's take a look. First, I, which stands for investment. Because the global demand for AI chips exploded, firms expected high future profits and therefore increased spending on factories, equipment, and technology. This results in an increase at investment. Now, let's take a look at NX, which stands for net exports. Because Taiwan became the world's primary supplier of advanced AI semiconductors, so foreign demand for Taiwanese chips rose dramatically. This resulted in an increase of net exports. Now for question 2. Use the aggregate demand, aggregate supply model to illustrate the impact of the AI boom on Taiwan's economy. Does this primarily represent a shift in aggregate demand, short-run aggregate supply, or both? Show the resulting impact on real GDP and the price level in the short run. The AI boom represents a simultaneous rightward shift of both aggregate demand, AD, and short-run aggregate supply, which is SRAS. Let's use the ADAS model to analyze it. Several factors increased AD, like higher investment spending, stronger export demand, and increased consumer spending from the wealth effect. Therefore, AD curve shift right, as on the chart from AD1 to AD2. Next, the case also mentions new factories, advanced chip facilities, increased productive capacity, and technological improvements. These increase the economy's ability to produce goods and services, shifting SRAS to the right, as can be seen on the chart from SRAS1 to SRAS2, a rightward shift. And the real GDP increases from Y1 to Y2. And normally, a massive demand shock triggers high inflation. However, because the supply side is expanding rapidly at the same time, so the price level remains uncertain. Whether it increases, decreases, or stays at the same depends on whether the AD shift outpaces the SRAS shift. Next, at question 3. Distinguish between foreign direct investment and foreign portfolio investment. Which examples from the text correspond to each term? Additionally, explain how these massive capital inflows affect the value of the new Taiwanese dollar. Let's compare FDI and FPI. First, FDI refers to foreign direct investments. FDI occurs when foreign firms make long-term investments and gain influence over productive assets. Some examples from this case are like NVIDIA building its NVIDIA Constellation headquarters, Google expanding R&D operations, and AWS building data centers. Now, let's take a look at foreign portfolio investments, known as FPI. FPI refers to purchasing financial assets without controlling the company. Some examples from this case would be like international investors buying Taiwanese stocks, capital flowing into the TWSE and purchases that pushed the TAIEX to record highs. But what are the impacts on New Taiwan dollar here? Let's first take a look at the process. First, foreign investors bring US dollars, which is USD, into Taiwan. They exchange USD for New Taiwan dollars, TWD. Next, the demand for TWD rises. As a result of this process, and then TWD appreciates. As a result of this process, TWD exchange rate increases. Imports become cheaper and exports become relatively more expensive to foreigners. Finally, for question 4, how does a booming stock market translate into real physical economic growth? Explain the theoretical link between rising asset prices and the marginal propensity to consume, which is MPC. So, when stock prices rise, households experience an increase in their perceived net worth, even if they haven't sold their shares yet. They feel financially safer and wealthier. MPC, which is marginal propensity to consume, measures how much consumer spending changes when income or wealth changes. As asset prices rise, the absolute value of household wealth climbs. This induces a positive shift in consumption behavior. Households increase their autonomous consumption, which drives up aggregate demand and forces businesses to hire and produce more.
My name is Zhang Xuanting, a second-year student from the Department of History. Today, I'm going to talk about Case 3, the USA-Iran War and Oil Crisis. Okay, let's just introduce the background. Just as the global economy was recovering from the inflationary pressures of the early 2020s, a devastating conflict erupted between the United States and Iran in early 2026. According to the International Energy Agency, this war has triggered the largest supply disruption in the history of the global oil market. Let's look at how this geopolitical shock fundamentally reshaped the global macroeconomics landscape. Okay, so first, let's address question 1 by comparing this crisis with the 2022 Russia-Ukraine war. While both events caused severe energy shocks, their structural impacts are quite different. The Russia-Ukraine war mainly disrupted Russian oil and natural gas export, especially affecting European energy markets. The impact was relatively gradual because it was largely driven by sanctions and trends in supply sources. And in contrast, the Iran-US conflict threatened oil production and transportation in the Persian Gulf, because this region is a key supplier of global oil. The conflict created an immediate risk of supply disruption and caused energy prices to rise much more rapidly. Okay, so the same question: why do conflicts in the Middle East cause global gasoline prices to rise so quickly and sharply? And so first, the Middle East remains one of the world's largest oil-producing hubs. This specific conflict instantly froze roughly 20 million barrels of oil per day out of the market, affecting 15 to 20% of the entire global oil supply. Second, the oil market is highly sensitive. Commodity traders react immediately to uncertainty and future supply risk. Within weeks, Brent crude oil leaped from $70 to nearly $120 per barrel. So, most importantly, Iran effectively closed the Strait of Hormuz, which is the world's most critical choke point for energy transportation. Because there are no viable short-term alternative routes, global supply suffocates overnight, causing U.S. gasoline prices to jump 30% to an average of $4.05 per gallon in just 2 months. Okay, so this brings us to question 2 and the concept of stagflation. By definition, stagflation is a rare and painful economic phenomenon characterized by simultaneously economic contraction, skyrocketing prices, and high unemployment. So, under normal economic downturns, prices usually fall as demand weakens. However, this crisis forced energy importing nations like Japan, South Korea, and European countries to face two microeconomic evils at the same time, which is inflation and recession. Their economics began to shrink even as their cost of living reached 40-year highs. Okay, and stagflation is notoriously difficult for a country to manage. If the central bank implements tight policy to fight inflation, it shows down sorry, it slows down business activity and increase unemployment. But if they implement expansionary policy to create jobs, they inject money into the economy and make inflation even worse. Policymakers are essentially trapped. Okay, so to visualize this, let's look at question 3 using the aggregate demand and aggregate supply model. So as global production and transportation costs surge due to high oil prices, the economy suffered a massive negative supply shock. On this graph, we can see short-run aggregate supply curve to shift downward from SRS1 to SRS2. So consequently, the economic equilibrium moves from point A to point B here. And at point B, we can clearly see the mechanics of stagflation. The price level increased from P1 to P2, which represents cost-push inflation. Meanwhile, real GDP decreases from Y1 to Y2, representing a severe recession. For energy importing nations, this unfavorable reality becomes deeply solidified. So now let's address question 4 using the flipped curve framework to see why a central bank cannot simply fix this using standard monetary policy. Okay, so when the negative supply shock hit, it didn't just move along the curve. It shifted the entire short-run fixed curve to the right, from SRPC1 to SRPC2. Because of this adverse shift, our original stable equilibrium at point A completely disappeared. Because point A is no longer on the active curve, and SRPC2, it is theoretically impossible for the central bank to restore the economy to its original low levels of inflation and unemployment simultaneously. Okay, so why does standard monetary policy fail here? Because adjustments to interest rate can only alter aggregate demand, which merely moves the economy along the existing SRPC2 curve. It cannot shift the curve back. If the central bank aggressively raises interest rate to fight inflation, the economy moves toward point C. Inflation is successfully lowered, but at the cost of a much higher unemployment rate. And on the other hand, if the central bank cuts interest rate to rescue the job market, the economy moves toward point D. Unemployment rate drops, but inflation spirals completely out of control. Therefore, the government is forced to accept highly unfavorable trade-off. Here, they must choose between lower inflation or higher unemployment rate at point C. or lower unemployment rate with hyperinflation in point D. They cannot have both. Okay, so in conclusion, the 2026 energy crisis proves that geopolitical supply shock strips are fundamental economic curves. Traditional monetary policy is stripped of its power, forcing government into a grim trade-off between inflation and unemployment. Okay, so thank you very much for your time and listening.